In our last lesson, we learned what a stock market is. Today, we're going to look at the historical record. We'll see that you can make a lot of money investing in stocks. We'll also see that there's no free lunch. If you want to try to make a lot of money, then you have to take some risks too. We also have to realize that investment advisors always include a disclaimer. I'm sure you've heard it before. Past performance is not necessarily indicative of future performance. We'll use some specific numbers to illustrate points, but the idea today is not to worry too much about those specific numbers. We want to get the big picture. What does the historical record say? Let's begin with the good news. It says that you can make a lot of money investing in stocks. If you had invested just $1 at the beginning of 1926 and reinvested all payouts such as dividends over the next 87 years, then you'd have done rather well. By the year 2013, a $1 investment in a broad portfolio of stocks would have been worth $2,843. Large company stocks wouldn't have done quite so well, but your $1 investment would still have turned into $2,103. The same investment in small stocks would have done remarkably better. Your $1 investment at the beginning of 1926 would have been worth $801,997. You'd have beaten the stuffing out of inflation, too. To maintain the buying power of the $1 you invested, you'd need just $12.83 in the year 2013. You would have earned more than 222 times that by investing in a broad portfolio of stocks. The main story that you can make a lot of money investing in stocks doesn't change much if we look at different selections of stocks according to characteristics like size. Sure, small stocks beat large stocks over the period from 1926 to 2012, but you would have made a lot of money in either asset class. The main story doesn't change much if we spread our investment equally among all companies, or if we had invested more in big companies than we did in small ones. You'll find differences by industry, of course, especially for relatively short periods. Sometimes financial stocks will do better than energy stocks, which might in turn beat transportation stocks. And sometimes transportation stocks will do better than financial stocks and energy stocks. But for the most part, the historical record seems to say that you just need to get into the market and stay there for a long time. I'll bet you know what's coming next, don't you? I'm going to change just one single word. I'm going to change make to lose. You might find that hard to believe by looking at stock returns over very long periods, and in some sense, you're right. The historical record does suggest that you can recover any losses in stocks if you stay in the market long enough. You'd have gotten absolutely hammered if you had needed the money from your 1928 investment at the beginning of 1933. You would have lost about 2/3 of your initial stake. True, your investment would have recovered almost all of the losses by 1936 or so, but you wouldn't have gotten back to the break-even point permanently until 1943. That's about 15 years. That's 15 years before you do much better than just break even, and even at that, we've ignored inflation. For most people, 15 years is a long time to have your portfolio be underwater. Would you have had the stomach to tough it out for that long, or would you have thrown up your hands and gotten out of the market somewhere along the way? What's more, I'm going to say the same thing that I said about the story not changing much if we look at different selections of stocks according to characteristics like size. You would have lost less in big companies, and you would have recovered a little sooner too. But it would still have been a rough ride for 10 years or so. And just like when we looked at the happier side of the story, the main point that you can lose a lot of money investing in stocks isn't going to change if you look at different industries, especially for relatively short periods. Just how good is a good year for stocks? And just how bad is a bad year? The answer to the good part is really, really good. Sadly, the answer to the bad part is really, really bad. You might want to sit down for this next part. Between the years 1926 and 2012, the best year return was in 1933, which checked in at almost 58%. The worst one-year return was in 1931, a loss of almost half, over 44.4%. Now, don't make the mistake of thinking that the downside is less damaging than the upside. If you start with $100 and suffer a 50% loss, then you have $50. It takes a gain of about 100% to make up for that 50% loss. What these numbers tell us is that the worst year and the best year are reasonably similar in the sense that they pretty much cancel each other out. Looking at historical rates of return over different time horizons tends to make people think that the longer you stay invested, then the safer you'll be. For example, from 1926 to 2012, one-year returns vary from a loss of about 44% to a gain of about 58%. For two-year returns, that range narrows to a loss of about 37% to a gain of about 38%. For 10 years, the range is from about a 2% loss to a gain of about 19%. For 50 years, the range is from a gain of about 7.4% to a gain of just over 13%. For 75 years, you can say that the rate of return is right around 10%, whether you have a good 75 years or a bad 75 years. The range is only from 9.4% to 11.7%. Lots of people interpret this as showing that the longer you stay in the market, the safer you'll be. Many of you have seen this idea promoted before, and if you haven't, then I'd bet you will soon. But the argument is simply wrong. The longer you stay in the market, the more risk you bear, not less. Yes, the range of potential rates of return does narrow over time, but the range of potential payoffs in dollars doesn't. The longer you're in the market, the bigger the potential losses and gains in dollar terms. And you buy things with dollars, not rates of return. Does it sound strange that even as the rates of return tend to even out over time, your dollar values don't? Most people think it does, but that's just the way it works. The intuition is that as the rates converge with time, you may miss by less each period, but you miss for a longer time period. Let's use an analogy that's more familiar to us. Suppose that you and your friend Lisa each take a car and set out on a long road trip. Lisa averages 60 miles per hour for the first hour, but you only average 50. After the first hour, you're 10 miles behind. Now suppose that during the second hour, both you and Lisa average 60 miles per hour. Lisa is still averaging 60 miles per hour, and now that you've covered another 60 miles to go with your previous 50, you've pulled your average up to 55. But you're still 10 miles behind Lisa. Think of it this way. Instead of falling 10 miles behind in 1 hour, you fell behind by an average of 5 miles per hour for 2 hours. You're in the same place relative to Lisa, either way you think of it. If you had averaged 58 miles per hour during the second hour instead of 60, then you would have lost another 2 miles and been 12 miles behind instead of 10. But the difference between your average speed and Lisa's average speed would still have narrowed, even though you lost more ground. Instead of 60 miles per hour for Lisa and 50 miles per hour for you after 1 hour, it'd be 60 for Lisa and 54 for you. You gain in terms of average speeds, but you lose in terms of miles because you lost ground for 2 hours instead of just 1. It's the same for rates of return. Suppose that the expected return on stocks averages 10% per year, but in your first year you earn 0. That's bad. You're 10% below the average annual return. Now let's suppose that next year you do get the average return of 10%. Your 2-year average is 5%, which is much closer to the true average of 10%, than the 0 you had for your first year. But you didn't gain a thing relative to the average during that second year. You just held your ground. Instead of falling 10% behind in 1 year, you fell 10% behind over 2 years, or an average of 5% for each of those 2 years. You're pretty much in the same place relative to the 10% average either way. The point is that rates of return and dollars earned are like miles per hour and miles traveled. You may miss the target by less each period, but because you miss for a longer time period, you can fall farther behind. What does this mean for the historical record of dollar values for investing in stocks? I'm willing to bet that you haven't seen the historical record for dollar values before, so let's take a look now. Sure enough, even though the range for the rates of return narrows with longer holding periods, the range of dollar values at the end of the holding period widens. If you start with an investment of $10,000, then you'd have just under $57,000 after the best 10 consecutive years during the sample period. That's about a 19% return each year. You'd lose a bit on average during the worst 10 consecutive years during the sample period, and you'd only have about $8,100 afterward. That 21% difference between the best and the worst period turns into a $49,000 difference, or almost 5 times your original investment. Over a 50-year horizon, when we know that the range of rates of return really has settled down quite a bit, the range of dollar values has nevertheless exploded. The worst 50-year period returned 7.4% annually, which would leave you with about $360,000. The best 50 years? That featured an annual return of 13.2%. What does that 5.8% per year mean in dollars? How does over $4.5 million sound? Yes, really. Even though the difference between the best rate of return and the worst rate of return narrowed from about 21% over the 10 years to less than 6% over 50 years, the best 50 years of stock performance would give you almost 14 times what the worst 50 years would give you. The 5.8% annual return differential really makes a difference over 50 years, doesn't it? Let's look at a 75-year horizon just to hammer home the point. Over the period from 1926 to 2012, the best 75-year period yielded an 11.7% annual return. The worst 75-year period wasn't far behind at 9.4%. That's just over 2 percentage points from best to worst. The range of rates of return has really shrunk. But how much difference in dollars can such small differences in rates of return make on a $10,000 investment? The answer may surprise you. It's almost $33 million. No, 2 percentage points isn't very much of a difference.